All right. Hello, everyone. Welcome to the first Don't Do Dumb webinar. I know there's some of you out there that have been to our live versions we've been doing in West Dundee near our office at DC Cobbs. We've started this series back in mid-September. We started this series, and we basically wanted to tell people why they should use financial advisors and to help them avoid making some key mistakes in some of their financial aspects. We've talked in our Don't Do Dumb series. We've talked about some of our distribution methodologies we use here in our practice, talking about distributions in terms of years and not percentages, which makes us a little different than some advisors out there. We've talked a little bit. We had one session talking about beneficiary designations and how we try to be a little bit more tax efficient in that. We've talked about fad investments and why they're not a good idea when going into your retirement portfolio. We had another session. We talked about micro subscriptions and how they may be bleeding your bank account. And that led us to tonight in our first webinar, where we're talking about charts and why they're not very important when it comes to your retirement investing. Jim, do you have anything you wanted to add?
Yeah, sure. First of all, that was Jim Madel. And I know depending on how your view looks, you may choose to be able to see us or not. And you probably do see the slide deck that we have going. The title screen says, "Don't do dumb, charts don't matter." But the whole purpose of this series of events that we're doing is to focus on why we believe that most people really should have a financial advisor. And as Jim mentioned, kind of focusing on the top mistakes that we see people making when they try to invest on their own. And one pretty big one is people getting into day trading and trying to find ways to game the system or beat the system. And when you're looking at investing, there's really two ways to analyze an investment. One is fundamentally, and fundamentally, that's talking about things like what is the management of a company doing? What are their price earnings ratios? What are their growth prospects? Just the fundamental things about looking at and running a business and deciding whether you think that that's a company you want to invest in or not. The second way is technical analysis. That's really what most charts are about, is technical analysis. And all technical analysis does is finds momentum. So you're looking at the past and seeing, hey, have people been buying or selling this particular stock or series of stocks or whatever the investment might be? And you try to read a chart to try to use the past to predict what the future might be. And I've done some pretty extensive research on this in my past, and I'll touch on some of those things later. But we're going to really talk today about why we feel that technical analysis doesn't really matter for the long-term investor and why you shouldn't get wrapped up in all of the emotion and it's almost like horoscopes in a way, trying not to worry about what your stock horoscopes might say by reading a chart. Instead of go with a real fundamental analysis and reading what your doctor might say rather than what the horoscope might say, I guess it might be an analogy. So I'll let Jim Madel is going to be the MC for this, and I'm going to chime in from time to time. So we'll let Jim take it away. And you can obviously type in some questions in the Q&A portion down of your display down on the bottom of your screen, and we'll try to address those as time goes on. And Jim, I'll let you take it away.
Yeah, thanks, Jim. Like he was just talking to, we do have that Q&A section. So we'll look to answer as many questions as we can following the presentation. So if you do have any, just type them in the Q&A section and we'll get to them at the end. So for now, let's dive into charts and why they don't matter when investing for your retirement. So charts can be very alluring in making investment decisions. They can either reinforce our beliefs and biases. They allow us to selectively interpret patterns to support our current or future investment decisions. Our brains as humans, they're wired to recognize patterns, which make charts very appealing when making decisions. They have colorful graphics representing peaks and valleys of stock movement over time. So we're naturally drawn to them. The use of charts, like Jim was talking about earlier, is known as technical analysis. And technical analysis uses tools and techniques in an attempt to identify trends, patterns, and support and resistance levels in stock market data. As investors, we're hoping to be able to anticipate future price movements in the market and thereby assisting in making informed trading decisions down the road. The information that's shown in charts is based on historical price volume or price and volume data rather than investor opinion or emotions. So that's really important. It's based largely on historical data, price and volume data of stocks rather than emotions. So let's take a look at some of the more common charts that are used in technical analysis. Okay, one of the most common that everyone's really familiar with in any line of work when you're looking at a chart is line charts. And they're probably the most common, and they offer a way for the technical analyst to visualize trends in stock prices. The line only represents the closing prices over time, but allows investors to identify upward and downward trends and potential support and or resistance levels. And what we mean by support and resistance levels, for people that aren't familiar with that, the support level is supposed to identify the point at which a stock price stops falling and then begins to rise historically. Alternately, the resistance level is where a stock normally stops rising and begins to drop. But as you can see, if you look at any line graph, you're going to see many times where the pattern breaks through the support and resistance lines. Okay, so it's key in the line charts.
Yeah, and I'll just if I might chime in just on line charts there, if you can back up one slide.
Absolutely.
So when you can see that somebody wrote these support trend lines and resistance trend lines in there, and again, resistance is supposed to theoretically show where sellers start feeling like stockholders start feeling like they should sell because the price is near a top. So the technical chartist might look at this and say, okay, if a stock breaks through a double top, that's a sign to buy. But in your mind, if you took those lines out of there, just in your own imagination right now, pretend those lines weren't in there, and say that you had to draw lines that kind of showed the tops and bottoms. You just as easily could start from the top of that mountain chart that kind of shows in January 22 there and make a line going the other direction, down instead of up, towards the, almost making a straight line between the January 22 and the June 2005 line. I'm sorry, 2002 and 2005 line. That would show that the trend kind of looks like it's going down. And I used to see this a lot in the early part of my career. I worked with some people who were technical chartists, and they would be drawing these support and resistance lines in there. And I'd be looking at it and I'd say, well, what if I decided that I thought this was where the line was? They said, well, yeah, you can do that. So, I mean, if you wanted to look at it that way, you can. So there's a lot of opinion even in reading these charts. And even financial advisors back in the day, back when we were stockbrokers rather than financial advisors, would use a lot of these technical details to try to make stock recommendations for clients. And again, we just don't think that's the best way to be a long-term investor. We're much more fundamental in the way we approach things. And we don't think that stocks and charts, we don't think that charts are a good way to judge stocks and when you're looking for a good, long-term, solid investment strategy.
Right. Another common one that a lot of people that try their hand at day trading are familiar with is candlestick charts. And candlestick charts use a candlestick-like graphic that represents intraday price changes of the stocks. The opening price and the closing price are shown in the body, okay? And then the top and the bottom are shown in what they call the wicks, and that'll show the high and lows for the day. They're easy to understand, and they provide a representation of price movements over a given period of time. So that's why they're very common in technical analysis. The open, high, low, close, or OHLC chart is akin to the candlestick, except it doesn't have the fancy candle body. It still shows all four intraday key price components, such as the opening price here, the closing price over here, and then this would be the high and low. The top of that and the bottom here would be the highs and lows. Both the OHLC and candlestick charts provide a more detailed view of market dynamics compared to a simple line chart. Okay, but again, as you're drawing in those support and resistance lines on any of these charts, it's very subjective. And lastly, the point and figure chart uses X's and O's to show upward and downward price movements. This type of visual representation is supposed to make it feel or make it easier for a technical analyst to identify trends and potential trading opportunities. Jim, do you have anything to add to point and figure charts?
Yeah, actually, I do have something to add on point and figure charts here. The point and figure is really kind of a way just to smooth out the noise in what you might get in a typical line chart or candlestick chart. And I did a great deal of study on this point and figure method because I did have somebody who used this method quite heavily in my office and swore by it when I first started in the industry way back in 2002. So I said, all right, if this is going to be something that he claims works, I'm going to test it. So I took 100 different stocks and I figured out their historical price data going back a number of years. I don't exactly remember how long I went, about like 15 years on 100 different stocks, and did point and figure charts for all of them. And I did it over varying time frames. So sometimes I'd look at 5 years, 10 years, 7 years, 15 years. So I sliced and diced the data a number of different ways. And I learned how to do these point and figure charts just as the book would tell you. And what I learned is that this is all these point and figure charts make you almost force you to have worse returns than whatever the return would be in the underlying stock or the underlying market. There are periods of time where you're going to get outperformance, but by and large, you're going to get underperformance. And what I learned was that not only point and figure, but really any technical analysis tool has you out of the market part of the time and in the market part of the time. And point and figure was a great tool during the bear market of 2001 because you spent part of the time out of the market in 2001, which kind of covered the time period that I was studying this. So I was studying it in 2002, and we were still kind of in the throes of the bear market that was occurred in 2001 and 2002. So it turns out the point and figure was working great during the bear market, but it also has you out during bull markets too. And so you miss out on a lot of bull markets because you're out, and you're in on a lot of, and you're out also in part of bear markets. So you outperform during a bear, but you underperform during a bull. And historically, we spend about 3 times longer in bull markets than we do in bear markets. So because we spend more time with the market going up than we do the market going down, this technical analysis tool, along with most other technical analysis tools, ends up to being a strategy that leads you to underperform the underlying holding for whatever you're charting here in point and figure. And you can do point and figure for a market. You can do it for an individual stock. You can do it for really any type of investment that you're trying to track. And again, it's a loser's game over the long haul. And I found that overwhelmingly in the very intense study that I did on this back in 2002 when I first got into the industry. I never did tell that to the other stock broker, quote unquote, that was in the office because I didn't want to be the new guy telling him how to run his business. But it is not a very good tool at all. And therefore, I decided I'd never make it part of my fundamental toolbox that I'm using when I'm recommending investments for our clients.
Excellent. So all the charts we just discussed rely heavily on historical data, which we know has limitations. So let's talk about that a little bit. Charts can truly only reflect past performance and can't predict future outcomes. Markets themselves evolve, and the factors that drive them change over time. Stocks that perform well during bear markets, such as your defensive sectors like utilities, healthcare, consumer staples, may not perform as well during bull markets. In addition, technological advances, government regulations, changing economic conditions, they can emerge and significantly impact the future price of a stock, which would not be reflected in a chart.
Yeah. So a chart might be telling you to buy a stock, but then they might get some news overnight saying that one of their key products causes cancer, and then the stock will plummet the next day. And that's a very extreme example. But stuff like that to a more minor extreme, it happens all the time in markets. So you might have a chart telling you one thing, but then a news item comes out the next day that sends things the other direction. And then your momentum completely changes, even though the chart might have told you that the momentum should go this way or should go that way. Again, it's just a really, really, really poor way of trying to use the past to predict the future. And again, we strongly advise against this. And day traders particularly tend to get heavily emotionally wrapped up in a lot of these charts. And emotion is just not a real good thing to have around when you're trying to make investment decisions. On top of that, when you're doing technical charting, and I think Jim's going to focus on this in a little bit, you get kind of over relying on momentum. So whenever you're doing technical analysis, the technical analysis basically always assume that whatever momentum you're having now is going to continue. So you're going to be buying when things are already up, and you're going to be selling when things are already down. And that in and of itself creates a bit of a loser strategy. We'll touch on that a little more in just a few slides.
Yeah. So relying solely on charts to make investment decisions can lead to flawed decisions. Charts oversimplify complex market interactions. They focus heavily on price and volume data of a stock, not the underlying factors such as the company's financial health, the management quality in that company, and what's out in the competitive landscape. Charts can fail to incorporate external factors too, such as current or anticipated economic conditions and global events. Charts can lead investors to emotional or impulsive trading decisions. So if you're over-reliant on a chart, it can lead to a lack of diversification and cause investors to use short-term trading strategies that are in stark contrast to what their long-term financial goals are, which is another big reason we're saying don't use charts when you're looking at your investment decisions, because if you're investing, it should be a long-term investment decision, and charts generally are used for short-term investing. So how do these external factors influence chart data? Let's look at herd mentality, and it can cause investors to follow the crowd. They're going to buy or sell stocks based on popular sentiment. A good example of this was back in 2021 with the infamous Reddit stock surge. Everyone was rushing out to buy Bed Bath & Beyond, AMC, and GameStop. Charts wouldn't have accounted for that type of emotional interaction on investment fads such as those. That type of impulse buying and selling is due to two of the worst emotional factors you can have as an investor: fear and greed. Okay, when the herd invests with these emotions, it can drive stock prices up way above or way below their intrinsic values. So with those stocks I mentioned earlier, you had people that got that hot stock tip and rushed out to do it. Again, would have never been in any chart that a technical analysis showed. So.
Yeah. And again, sorry, Jim, if I might just comment a little bit.
Yeah.
So again, talking about the herd mentality, you don't want to be, Financial Advisor 101, and a lot of you might have heard me say this, those of you who are our clients out there might have heard me say that, Financial Advisor 101 says buy low, sell high. And that flies in the face of what technical analysis and technical charting has you do. Again, technical charting will have you buy when a stock breaks through a recent high, typically. That is when you'll buy, and then you won't sell until it breaks through a recent low. So again, that can be good in short, very, very, very short-term cases at times and capture short-term momentum. But as a long-term strategy, you're going to be missing out when the stocks, when the market or whatever issue you're tracking is going up. You're going to miss out on a lot of the upside. You'll be out for a lot of the downside, but you're going to miss out on a lot of the upside as well. And generally, that's a bad thing. And I'll quote Warren Buffett here. And again, we want to keep emotion out of investing, but he talked about his own emotion when he's investing, and it just flies in the face of what technical analysis is all about. Warren Buffett says, "Be fearful when others are greedy, and be greedy when others are fearful." And technical analysis has you do exactly the opposite. And I've seen time and time again, the whole reason this is a topic for us today is because we've had clients come to us saying, "Hey, I'm doing day trading now. I want to try this day trading. And I'm following these charts. And hey, this is how I'm going to trade myself to riches." 95% of day traders trade themselves out of business. So that means that the overwhelming majority of day traders eventually lose money day trading, even though there's a lot of success stories and people only talk about their successes. So I'm sure you've had somebody talk to you before about, oh, hey, I got in on this stock and I made all this money on it. They're typically only talking about their successes and not about their failures. And again, when it comes to day trading, the overwhelming majority of people are failures, and things like technical analysis just lead you toward failure, not toward success. So
correct. The chart patterns themselves also influence investor sentiment and have investors, like Jim was saying, buying during bullish patterns or selling during bearish markets, which drives prices up or down further based solely on these artificial external factors. Market psychology and investor sentiment can distort chart data and make it difficult to identify true market trends. Investors should be aware that these influence on the market and consider diversification and long-term investing to make more rational, sustainable investment decisions. So why is diversification important? A diversified portfolio avoids reliance on a single asset or sector and mitigates downturns in specific industries. It also captures broader market opportunities, allowing you to participate in the growth of a variety of market sectors over your investment time horizon. Diversification allows you to tailor your portfolio to your specific risk tolerance and time horizon. Any of you that are our clients out there know how we use the bucket system, and we have specific investment plans for both our long-term and our short-term assets. Also, sticking to a diversified portfolio allows you to reduce your emotional bias of fear and greed by sticking to a long-term investment plan.
Yeah, in just talking about diversification a little bit, I'll go back to an example. And again, a lot of you might have heard me use this example before. I've mentioned this in other public speaking engagements, and occasionally I'll bring up this story during client meetings. But back in 2008, again, I knew of some people who were touting Bear Stearns stock because Bear Stearns stock in 2007 was sending off a lot of buy signals. And there was even a very famous person on TV who I won't mention, but he was singing the virtues of buying Bear Stearns stock based on the technicals and fundamentals, both that existed in that particular holding. Well, Bear Stearns went through quite a crash, and Bear Stearns, I actually saw a documentary one time. This is going back quite a ways. It was 2020 or 60 Minutes or something like that. I don't remember exactly what it was, but it highlighted a lot of the mid-level managers that were part of the trading operation at Bear Stearns. They were responsible for trading some of the companies. I won't get into too much of the detail, but they had some leveraged products that they were trading with other banks. And these people that they were focusing on for the documentary were the people that all worked on one floor of the Bear Stearns headquarters on Wall Street. And they showed up for work on a Friday morning after going on, they showed people going back and forth on the Staten Island Ferry, living in New Jersey, coming to work in Lower Manhattan, and getting on the Staten Island Ferry. And all of a sudden they show up for work one morning, a Friday morning. I believe it was right around St. Patrick's Day of 2008. And the doors were locked to Bear Stearns, or the doors were at least locked to their floor. They couldn't get into their job that day. And the stock had gone down from July 17th of 2007. Bear Stearns stock was trading just under $140 a share. And on March 16th, so one day before St. Patrick's Day of 2008, it was sold to JP Morgan for $2 a share. So it had gone from $140 a share down to $2 a share. And the reason I bring this up during the diversification portion of this is because many of those Bear Stearns managers who had jobs that were paying them north of $200,000 a year were being forced to put their retirement portfolio into Bear Stearns stock. And people just as recently as a few days before the collapse were thinking what a great idea that was, because we got this famous guy on TV saying that the momentum is going to be good. It's definitely worth buying. We've got our $200,000 job plus salary with this company, and also our retirement portfolio with this company. Well, in a matter of days, on March 12th, 2008, the stock was already down, but it was only down to $61.58. And again, by March 16th, just 4 days later, it was down to $2. So people who had a $500,000 portfolio and a $200,000 a year job all of a sudden had close to nothing and nothing. No income, no retirement anymore because they weren't diversified. So that kind of deviates from what we're talking here about technical analysis a bit. But the reason I bring it up with this is because there were people singing the virtues of Bear Stearns from a technical perspective not long before Bear Stearns went belly up. So it's important to, again, not get overly emotionally involved in any investment. Keep your investments diversified. And again, a financial advisor can help get the emotion out of this for you. We don't want to be emotional about our investing decisions, and to keep the noise from creeping in, the noise you might hear around the water cooler, or the noise about, hey, look at this stock that's going through the roof. You need to get in before it's too late, before the train leaves the station, and so forth. So again, it's all about just trying to keep a level head and trying to do technical analysis. Its kind of foundation is not very level headed to begin with, in my opinion.
It's true. That's true. Wrapping up the part of diversification, studies have shown that diversified portfolios tend to outperform non-diversified portfolios over the long term. It reduces the impact of short-term volatility and enhances the potential for consistent long-term growth. Diversification also provides peace of mind, like Jim was talking about, by not having to stress over being over-allocated in a single sector or asset, such as Bear Stearns. And lastly, a diversified portfolio allows you to align your investment strategies with your specific financial goals and objectives. So, in summary, while charts visually represent market movements over time, they just don't incorporate other key external factors, and therefore shouldn't be the only thing on which we base investment decisions. For long-term investment decisions, we don't feel they should be used at all. Investors that closely follow charting and technical analysis, as Jim was alluding to before, are out of the market for a span of time during bull markets, losing out on initial upward trends. Always remember to remain free of emotional factors such as fear and greed when investing, or remember Warren Buffett's quote. What was that again, Jim?
Be fearful when others are greedy, and greedy when others are fearful. So it's a bit of a contrarian approach. And so sure. Basically, he says it's okay to have emotion, but just the opposite emotion of everybody else. Yep. We try to say in our office, just try to keep your emotions out of it altogether, because it'll lead you toward an incorrect decision. So
that's right. And diversification of your portfolio based on your personal time horizon is key to building a successful long-term investment plan. And I guess one of the big things to remember here is that historical market data absolutely has limitations, and past performance is not indicative of future results. They make us say that, they make us put it on everything because it's true. And stock charts, technical analysis leans heavily on that. So the charts are basically trying to show you that past performance is going to be future results, and that's not true. All the factors we discussed earlier play a big part in driving stock prices up or down.
Yeah. One thing that's kind of fascinating to me is, and I'm talking to people in this profession over the years, I had several people that I've come across in the past that were interested in charting not just individual stocks, but indices as well, like the S&P 500 index. And so you have people using technical analysis to look at what the stock market as a whole might do. When you're thinking about the S&P 500 index, or maybe even a better example would be the Dow Jones Industrial Average, because the Dow Jones Industrial Average is just an index of 30 companies. So if something good or bad happens to any one of those 30 companies, it could have a relatively profound effect on the performance of the index. And when you're trying to use a chart to predict whether a particular market is going to go up or down, in the case of the Dow Jones Industrial Average, a news item for any one of those 30 companies will throw your chart completely off. So it always was kind of questionable to me from the get-go, even before I did any of this analysis that I've done, to say, how is it possible to chart an index when an index can be upset by the action of any one of its underlying holdings? So again, we don't want to beat this too much here, but we can't stress enough at the same time that when it comes to making your long-term investment decisions, a long-term strategic plan of being in the market through thick and thin with your longer-term monies is the best strategy and then being out of the market with your shorter term monies and not letting it be in something more volatile is also part of a good long-term strategy. And that's what we really focus on in our office. And that's the main message we wanted to get through today. We are doing a series of these Don't Do Dumbs. We're going to highlight the common mistakes. We're going to keep doing virtual versions. We'll also have some live versions. We'll still be doing more meetings at DC Cobb. You can check our calendar on our website, the events section, to see when we're going to be doing these. Jim's going to mention that too. And we're going to keep going with these throughout 2024. Our plan is to keep doing these about every 2 weeks or so. And some will be virtual, some will be live. And if you have recommendations as to what you'd like to see us talk about, please feel free to make suggestions, and we'll incorporate some viewer suggestions. And again, it's all about things that a financial advisor can help you do so you don't make mistakes in investing on your own.
Yeah, thanks, Jim. Our next virtual seminar is scheduled for February 28th right now, but based on any feedback we get from today's session, we could be coerced to maybe change a few of the other ones to be virtual. So the next one right now that's scheduled is going to be scheduled for February 28th. And that one is Don't Buy Life Insurance from a Person Who Only Sells Life Insurance. For those clients that are in the nearby area or have attended the Don't Do Dumbs at DC Cobb's in West Dundee, our next one is scheduled for December 20th, and it will be covering financial planning software starts with a major flaw. Then on January 10th, we'll be talking about procrastination by covering It's Not Too Late Today, but It Is Tomorrow, and basically covering how procrastination can cost you some gains in the market. January 24th will be No Need to Rush Paying Off Your Mortgage. That should be a fun-filled topic at DC Cobb's that night. So those are a few of the topics we have coming up. I see a comment in the question and answer. I don't have any questions yet. Does anyone want to type in a question? Are there any questions?
In the meantime, just to summarize the comment we got from Sean, not my brother Sean, a client of ours, Sean. He says that basically this is good stuff. He was talking to his son about investing, and they were talking about how long-term investing should be boring. Put it in and let it grow. And there's a lot of truth to that. It's not about trying to catch lightning in a bottle. It's about just being slow and steady, winning the race, being strategic about the way you approach things, and not letting any outside factors, any emotion get in the way. And we're really super excited to get comments from people like Sean. Sean's out of state, out of Illinois. I'm actually speaking to you from Florida today. But we're really excited to open this up to our clients across the country. We've got clients in 36 or 37 different states now. Yeah. And we want to make sure that we're including everybody in the ability to attend these. And we really encourage you, if you like what you're seeing today, to tell your friends. This is not just for clients. This is for people that anybody who could use some helpful hints when it comes to investing. And again, we're kind of trying to tackle them one at a time, one idea, one topic at a time, and build a framework around some ways that an advisor really can be helpful to most people.
Absolutely. And as Jim alluded to, if you have any topics you'd like to see us discuss, feel free to email us at info@jghfs.com. You can go to our website for any of our email addresses, and just feel free to email any of us in the office, and we'll try to get that topic covered if we think we can get to it. So again, this is all for you guys. So I don't see any other questions. I see Rita posted another thing about liking the option to attend virtually if we have an interesting meeting that is live. So this webinar has also been recorded, so we will be posting this out to our website. And as I was saying earlier, we do have a couple of these that we're turning into blog posts on our website as well. Currently, we have about beneficiary designations and how we think about that. And we also have a blog on our micro subscriptions bleeding your bank account. That's out on our website. If you go into resources, I think the top drop-down selection is about the blogs. So you should be able to access any of that there. if you go to our events page, that's where you can sign up for any of the future Don't Do Dumb sessions. Again, a lot of these are going to be local for the next few, but starting in January, we'll have a couple, or I'm sorry, February, we'll have another virtual. So,
and we just got a question from Doug that I'll handle here. It says, what are your thoughts about index funds like total stock market or total bond market, as well as international funds? So index funds are actually good investments. They have historically done better than the average mutual fund out there. So, but at the same time, in our practice, we don't really use too many index funds. Well, you might say, well, if they're good investments, why don't you use too many of them? Well, historically, index funds will generally beat actively managed counterparts. So a difference for those who might not know, an index fund is a fund that just tracks an index. So there's no manager using their brain to make buy and sell decisions on what stocks or bonds they think they might want to buy for their portfolio. It's just tracking to an index. And for instance, the S&P 500 is an index of the largest 500 US-based companies by market capitalization. So the S&P 500 index just tracks that index, and that's all it does. So you hear on the news that the S&P 500 index went up or down X amount of percent each day. An S&P 500 index fund is going to do virtually that same thing. Usually they'll lose to the index by just a little bit because there is a little bit of cost involved in running those index funds, but they're going to very closely track that index. And again, 6 out of 10 times, if you were comparing it to an actively managed fund where somebody is using their brain to make buy and sell decisions, then the index fund will outperform 6 out of 10 actively managed funds in a given year. And so that might lead one to think, okay, well, I'm just going to invest in index funds and stick with that. Well, the flip side of that is that 4 of every 10 actively managed funds beat an index in a given year. And of those 4 of 10 that beat the index, some of those 4 out of 10 have a long-term track record of doing it rather consistently. No fund beats their index all the time. But there are funds that have been very consistent about beating their index. And those are the funds that we're using in our practice. And again, we have to say that past performance is not indicative of future results. And just because a fund beat the index the last 10 years doesn't mean it'll do it next year by any definition. And again, no fund beats its index every year. But we feel like we're stacking the deck in your favor as best we can by using actively managed funds instead of index funds. Now, the question also asked about international funds. I don't know if that meant particularly an index, but we are fans of international funds in our practice as well. I've been a fan of international investing for years and years and years. International investments haven't gone as well as their domestic counterparts for the last handful of years. But what we feel is happening is there's a stage being set for a nice international rally. Valuations, if you compare companies domestically versus internationally, generally speaking, the international companies look a little more cheaper using fundamental analysis, not technical analysis, but fundamental analysis. The international companies look a little more attractive based on traditional valuation metrics. So we're pretty bullish on international holdings for the long haul. So thanks, Doug, for the question, and I hope I did a sufficient job answering that.
Yeah. Michael had a question asking if we can send the slides out in email. As soon as our compliance officer comes in tomorrow, I will make sure I have the right legal mumbo jumbo on the slide deck, and I can certainly send it out to everyone in a deck. As I said before, this will also be recorded, and I will look for a way to get it onto our website. So you should be able to access that as well, but I can definitely send out a copy once I get this teed up and approved via compliance to send out.
And then we've got a question here from William that says he has friends that are worried next year is going to be a terrible year for the economy and the country. Should I just reassure them to stay the course? Thanks. Well, first of all, if you've been around long enough, you know there's always somebody that's saying, hey, next year's going to be terrible. Or I've been in this business for 20 plus years now, and there's always some talking head or always somebody that's saying, hey, a recession's coming next year, a recession's coming next year, a recession's coming next year. Once in a while, those people are going to be right. But our whole mantra with investing is we're only using the stock market for funds that are long-term in nature, monies that you generally don't need to spend for 5 years or more. And for some people, that baseline is longer than 5 years. So for 5 years or longer, we don't want to put or we don't only want to use the stock market for monies you might need in no sooner than 5 years. So yes, those investments might come down, but what we've learned historically is that when we have recessions, the 2001 recession, the market fully recovered in less than 5 years. It took about 4.5 years. In 2008, it was about 3.5 years. So the markets have rebounded fairly quickly from recessions. And therefore, if we have a 5-year time horizon, yes, the portfolio might go down next year, but it should recover enough by the time you're going to need to spend that money that we won't be forced to sell it low. And for everybody who retires, and again, you've heard us talk about this if you're working with us, we have your shorter term money and safer stuff, your longer term money and more aggressive stuff, generally speaking. And that helps us make sure that we're kind of building a safety net so that we'll never be forced to sell anything low. If the market's down while you're retired, while you're needing your money, and if most of you are building a portfolio, you're likely going to have a recession during your retirement years. If and when that happens, we're not going to be forced to sell anything low because we're going to have a nice nest egg of more conservative holdings built underneath your portfolio.
Yep.
So no, don't panic.
In summary.
Yeah.
All right.
Okay, great questions there. We'll still stick around for a couple more minutes if anybody has any more. We're kind of nearing the end of our time, but we still got a little bit of time left. We can hang out for a few more minutes if people want to ask questions. If you don't want to put your question publicly, again, Jim gave the public email that you can use. It's info@jghfs.com. You can email your questions there. You can also call our office. Nobody's going to be there later this evening to answer your call live, but you can always leave a voicemail. You can call our office at 847-428-3997. That's on the bottom left of your screen. That's our main office. We have other, if you're in a different part of the country, you might have a different phone number listed. Whatever phone number you have for us, that's the number you can call. That'll ring into that same voicemail box as the main company number at 847-428-3997.
Excellent.
Okay, we got most of the people who said they were going to be here actually did attend. We had a few no-shows today. And looking at the names that are here, we got some familiar faces that have been to a lot of these before. We've also got some people who haven't been to these before. And very impressively, I'm really happy that we have some people from all across the country attending today too. I see for some people in Georgia, some people in Tennessee, some people from Colorado. Let's see, Florida, lots of places spread out throughout the country I see represented here. So that's really great to see. And we're going to try to keep this going and try building it so we can get more representation from more parts of the country as we continue to do these as well. Absolutely.
And we also appreciate you bearing with us. We hope this went through in a good manner, because this is our first attempt at doing this webinar. So we got to try the software, but this is our first time putting it to actual use. So if you can provide any feedback on how the presentation went through, if there were any bumps in there or if everything came through. I know, like, for instance, not that you guys need to see me, but I can't see myself here. So I don't know if I'm actually visible here. My camera's on, but it looks like I am blanked out here. So
yeah. And I can see myself. I can actually see Jim Madel kind of as a ghost, kind of close to the Hendrix logo on the slide.
Oh, really?
It's almost like he's behind the slides. Yeah.
Yeah. Well,
we'll figure out that part of it, but
that'll be something I will work on. I will try to figure out how to get myself out of there eventually.
And again, I think you have, as a participant, you have some control over what you can see by clicking up at the top right. You can see the film strip view or the speaker view or the gallery view. And I think that can alter what you as a participant can see. So you have some headway over, some leeway over what you can and can't see, but you always should be able to see our slide deck, which right now has the summary page on it. So you should always be able to see that.
All right, a lot more great positive comments here. Thank you, Rita, for telling us that you could hear and see everything okay. So that's excellent to hear. So that's maybe a little bit of a push for us to do a few more of these virtually if it works well. I like the virtual because, like Jim said, it opens it up to more of our clients and any of your friends across the country, rather than tying it down to our local area here. We won't get rid of the local one for any of you that still attend that. We'll still do those. We just may add in a few more webinars if need be. So.
All right. Well, no new questions coming in. Some good feedback coming in. We appreciate all the feedback. If there's no further questions, we'll wrap it up for this one. Thank you for attending our Don't Do Dumb series, and and please be on the lookout for invitations to these as we keep having them throughout 2024. Thanks again, everybody.
And Doug, really quickly, to answer yours, you're probably better off only seeing Jim because I have a face for radio. So, but next time I'll try to get my picture up there on online. We appreciate you guys. Thank you so much for attending.
Okay. Bye-bye. Thanks, everybody.